Most of you know I'm Tracy Themes. I'm co-founder of Sophia Financial Group. We're a full-service financial advisory firm. As you can see, we do both financial planning and the portfolio management, typically with clients with $500,000 or more in investable assets. We also do a day a week of pro bono work. So in the course of a week, we basically work with the whole spectrum of wealth in Vancouver citizens, from some of the very poorest to some of the wealthiest. And I think that gives us a really good depth and breadth of understanding of what's going on. How we work here is very comprehensive. So our team has areas of specialization. And then we like to say that we want people to boss their money around and not vice versa. So before we get started, because I forgot I had it down here too. I wanted to introduce you. For years, you know people who've been with me, I've been by myself in these evenings and Saturdays for years, and I keep forgetting to introduce my team members, and I have forgotten for the last 6 times. So anyways, if you wouldn't mind, Aaron Seibel is the other financial advisor here, who's also insurance licensed, and Tiffany Green, who's on her way to becoming a financial planning goddess. Mila left for the evening. Many of you have met her over the last few seminars that we've had. So what we try to do is create a context for wealth. It's never just about the money. It's never just about the numbers. It's never just about the investments. It's about how does this whole picture serve the person? How are the values reflected in what we do? And how are we going to get all the pieces of their puzzle to all come together in a cogent whole? So up until now, we've never really addressed the insurance piece, except in the discussion of the 5 steps of financial planning. You don't want to be nodding, because then I'm going to look at you and I'm going to say, do you remember? Oh, she's now her head goes down. Do you remember the first question that's addressed in the first step of financial planning? Anybody remember? I always feel good about myself until I ask this question, and no one in the room who's even listened to me 15 times can remember anything I've said in the last 10 years. First step is, where am I now? And if you're, now you're nodding. That sounds familiar, right? And do you remember, by any chance, do you remember the 2 components of where am I now that we look at?
Net worth.
Right. Good. That's great. One for the home team. And do you remember what net worth is?
Your values and your assets and your debts.
Right. Assets minus liabilities. Excellent. And does anybody remember the other piece of where am I now? Yes. Who said it? Don't be scared. Oh, it's you again. Cash flow. And what is cash flow?
Paying expenses.
Right. So that's money out versus money in, but money out. So what we always say is, every decision that you've made about cash flow to date shows up on your net worth. So that is basically your report card of how things are working for you in your day-to-day. We also say it might take you a year or even 2 years to change your net worth, but you can change your cash flow in 10 minutes. You could just basically buy us all around a tequila, and your cash flow would change immediately, right? So this is the first piece. We need to know where we're starting on our journey. The second step in the Sophia 5-step plan is, do I have cash reserve, and have I put in my protective gestures? So do you remember what cash reserve means and why we have it? Just use, now you know, I know you know.
Fund?
Yeah, exactly. But also what's the opposite of an emergency?
Savings.
Yeah, opportunity, right? We just like to have our hands on, be able to access cash within under 24 hours, so that the inevitable things that happen in life we can manage, so that we become our own bank. We borrow from ourselves, and then we give back to ourselves. Because if we don't have that, what do we have to do? We borrow from either somebody else or another institution, and they charge us interest, whereas we are an interest-free banker, right? So we also have spent whole months talking about what it feels like when you have enough in savings that you are empowered to make the decisions that work for you. You can leave situations you want to leave. You can handle the emergencies. You can take advantage of the opportunities. And there's a huge psychological advantage to everybody to know that you have yourself the means to enact the decisions that are important to you and the people that you care about. The second part of cash reserve are the protective gestures that you can put in lots of times because you can't always anticipate what will happen, or there are certain things that we know could. We always know we could pass away. We always know we could get into a car accident. We always know that things could happen, but we aren't always sure of the degree that those things, how they could affect us and our family. So today, we decided to concentrate on the second piece of the second step of the 5. I just want you to have the whole, you know, that we don't just, around here, we don't just pluck stuff out. Like, it feels like it, but we're not just here, oh, you need to buy a REIT, or oh, you need to buy a piece of insurance. It's important for us all to understand in a comprehensive financial plan, what are the actions that fit with each one of these steps that works for us? To me, that's the base of power. The base of power is having your own plan and understanding every step that you take and every decision you make and how it fits into the comprehensive whole of your life. So we are very fortunate that we have with us tonight Jacqueline Knoblauch. Is that how I say your last name? Okay. I asked her how to speak her first name. A friend of mine kept calling her Jacqueline. You have to make sure you call her Jacqueline. So I called up, I said, like, Jacqueline, and you're like, and I'm like, well, Vicky said I have to call you this, and she's like, she's the only person that ever calls me that. And I was like, oh, why don't you tell her? And then I kept thinking about these seniors at my church 20 years ago, and one of them called me Terry one day, and then it caught on. And now when I go to Olympia, Washington, 25 years later, I can still hear down Capitol, Terry, and I turn and answer hello, because you missed that point, right, where you can comfortably say, but you were at the comfortable point with me to say it's Jacqueline, okay, people, it's Jacqueline. So we're very fortunate, and she loves insurance, and you get quite excited about it sometimes, I know, which are the best people to teach about it. She's a certified financial planner. She has her chartered life underwriter, which is a very difficult designation to get. She is the national insurance specialist for Raymond James Financial Planning, and she's considered the go-to resource for all the financial advisors across the country. She has a BA in geography, and I think that helps you get the lay of the land faster than ever the people. That's what I decided. It was a perfect thing for someone doing your job all day, because you can figure out, like, am I in Mexico? Where are we headed here with this plan? Are we headed in the right direction? Her background includes brokering high-risk loans and mortgages, acting as an independent investment advisor, and she's been employed as a senior financial planner for a bank-owned firm. So, I mean, she doesn't look like she's 82, but she has a long history. Currently, she sits on the board of the Vancouver chapter of Avacus, and Avacus is our country's largest voluntary professional membership association. She's going to be teaching a class on ethics next week, which is a perfect fit for how Sophia operates. She's just somebody we really admire. She has a stellar reputation, and just even the fact that she's on the board of Avacus shows that she is respected greatly amongst her peers. So you will also notice, not only am I going to welcome you, but we have a camera here, and this is because we're experimenting with being able to record some of these sessions so that people who can't make it tonight for one reason or another can still have access to this very valuable information. So thank you for bearing with us while we experiment with this format, and I'd like you to join me in welcoming Jacqueline. Thank you.
Thank you. Hello. So I've got some questions. A lot of it's going to be questions, and I'm hoping it's a conversation, and I hope you have some questions, and this is not a 2-hour insurance seminar, because that would be a lot even for myself, as much as I like insurance. So I'll start with some questions, actually, just so that I can get a feel for the room. Does anybody here own insurance? Does anybody actually have, whether it's life insurance, critical illness insurance, disability insurance, group benefits from their employer? Okay, so there's some familiarity already. Who here is still working? Okay, anybody work for themselves? Okay, pick on you later. Insurance naturally has integration with estate planning, so a lot of the conversations I have are the death and dismemberment and disease and all the fun stuff on a regular basis. Does anybody have a will in place? Have they taken? Awesome. Okay, so that gives me some kind of bearing on some questions. Insurance can run the gamut on what does that mean, what does that look like. Most people have some form of car insurance, they have home insurance, if they rent they have tenants insurance, life insurance, critical illness insurance, disability insurance. They all do the same thing. You pay a portion of dollars, whether it's per month or per year, to some institution, and the idea is that if any of those insured events happen, someone passes away, someone gets diagnosed with a critical illness, someone is disabled and unable to go to their job and generate their income, the insurance company comes in and says, well, you paid us that premium, now we owe you what we said we were going to owe you, and they pay out the life insurance, the critical illness, or the disability income. So that is a coordinated contractual relationship from the get-go. What we find when we're talking to clients, though, is a lot of the questions are, I don't know what I should have, I don't know what I do have, I don't know what I should be asking questions about, because as we just talked about, nobody really talks about insurance. It's not something that you are learning in school. Most parents don't have the information to then pass on to children and then continue on with that. So it is this kind of gray, murky area of conversation, which is in a bigger gray, murky area of conversation of financial planning in general, which just continues to get more complicated and confusing as time goes on. You add in different RSP accounts, tax-free savings account, they have new first-time home buyer accounts. Nothing's getting easier. So for the purpose of today, the conversation is insurance, but I recognize that that integrates in with all over on the financial picture scale. So if you have questions that you either are just curious about or you think it relates to insurance, happy to address those as well. And if there's a question that I don't know, we'll just table it and we'll figure out the answers after, if that works for everybody. So the first thing that I thought to think about is, for the purpose of tonight, what type of insurance are we talking about? And so primarily for today, we're looking at, I'll say, health-related insurance. And so that comes into 4 parts. So the easiest, most common, I think that most people are familiar with is life insurance. And you go, oh, that's an easy one, life insurance. Okay, we can move on to the other one. The problem with that is life insurance has various types of life insurance inside of it. So the most common that most people are probably familiar with, and many of you probably have had or do have, is something called term insurance. And so what that means is you purchase an amount. So if someone has a mortgage in Vancouver, it's not uncommon anymore to have a $500 or $1 million mortgage. And you say, well, I need mortgage insurance. I need $1 million of insurance to cover my $1 million mortgage. And now we look at how long is your mortgage, maybe 25 or 30 years. And so we get the equivalent 25 or 30-year term insurance. So you pay a premium to the insurance company, and they say for the 25 or 30 years, we guarantee your premium stays the same, the coverage stays the same, we can't change anything on our end, and as long as you pay the premium, that's the contract. For a risk purpose, for young families that have that $1 million mortgage, and that's a sizable amount of money owing, maybe there's only one income supporting that, making sure that there's the insurance in place to cover that should something happen to the main person who's responsible for paying that mortgage every month. That's important. And we look at those types of insurances because the cost of them, the premium, is the lowest you're going to get. So it's the lowest cost of insurance. There's not a lot of bells and whistles. It's there to do a job. Someone passes away in that term. Its job is to pay out the premium, and that's it, which is a good thing. Following that, there are 2 other types of insurances. So there's permanent insurance, and there is one type that you can do some interesting investing things in. You can have the value go up and down. The cost of the premium can go up and down. There's a lot of moving parts to it, and that's interesting for a lot of people who, whether they're self-employed, like your real estate developers or your realtors or your people who operate businesses, where cash flow from one year to the other can be quite drastic. they might want that flexibility. They might want those changing positions so that they can build wealth, increase coverage, do investments, do various things, and they don't need that set low cost type of premium like the normal individual who goes to job, collects the paycheck, and has more of a stable income cash flow. And then the third consideration is something called whole life insurance. And one thing that matters to me, and based on what I do, and Trace said I'm speaking about ethics next week at a presentation and how this group and team operates, is not every insurance policy is suitable to every person, much like not every investment opportunity is suitable to every person. So unfortunately, insurance in general can attract individuals who, to me, just don't do the job properly. So they're there for their own self-interest, and they're not there for the people they're talking to. And I'm sure you can find that across many industries. Given what I do, I just see it, unfortunately, too much. So for people who are on a specific cash flow, they don't have all this extra reserve. Maybe they're really young, they don't even have children, but someone's brother's cousin's nephew, whatever, just got their insurance license, and you need to talk to them because they need to talk to 30 people to qualify for their graduation bonus or whatever. It's really easy to look at this thing called whole life insurance. And on paper, it looks fantastic. You put money in, the values grow over time, tax-free, and then at the end of it, you have all this money to pull from for your retirement, and then even after that, you have all this life insurance for the kids that you might not even have today yet. And on paper, it looks really good. In theory, that does not do the job that most young people with limited cash flows need, because they should actually, hopefully, try and strive for some money in their TFSA, or some money to put towards their RRSP, or maybe some money for a down payment to ever try and own a piece of property in Vancouver. So there's all these steps that you need to, I think, take in your full financial picture before anyone should ever look at whole life insurance. And the only reason I speak about that is it's something that online, I probably get asked the most from people on social media. I saw this cool thing online. You can be your own bank, you can be an independent banker, you can borrow from yourself, it's tax-free, and it's got all these really good buzzwords. And whole life insurance is something that I think is one of the most interesting things about life insurance and tax planning and corporate estate planning, and I love utilizing it for the right scenario. And so online, you're getting these little snippets, and for young people, that's all they're seeing, and so they think it's cool. So the only reason I wanted to share was, one, depending on who watches the recording later, but also if that's coming across yourself or if it's coming across family members and they're talking about it, to just caution, make sure that's the right thing for them at the right time. So that's life insurance. The next two are what's called living benefits. So with living benefits, thankfully that's a bit more optimistic of a scenario. No one's passing away. Sadly, they're related to critical illness diagnosis and disability diagnosis. So critical illness insurance, you purchase a certain amount. So often that is 1 or 2 times what your income might be, or you're looking at your expenses and saying 1 or 2 years of your annual expenses. You select a certain amount of coverage. And then same thing like that term insurance, you pay that premium on an ongoing basis. And if you should get diagnosed with that critical illness, you then get a tax-free payment to yourself. And similar to how you ideally structure your regular financial situation, you save in, try to give yourself some money and accommodation so that if an emergency or an opportunity comes up, you're not stuck with, I've got to make a hard decision based on limited funds because that's my position. My concern is always, why would someone, ideally, if we can give them enough capital so that if they're actually dealing with critical illness, they have money to draw from to then make choices. I wouldn't want to have to make a health decision limited based on the resources that I have available. If I get diagnosed with a critical illness, I'm not going to wait for the 4 months to get into the BC Cancer Agency, which thankfully is better than nothing, but I want to be on the plane to Switzerland, get me whatever it is that is needed to help me get safe and get back home to my family and hopefully live longevity. So for those that have the capacity to purchase critical illness and have the ability to make the premiums on that, to have that extra capital come in should you unfortunately be diagnosed with a health event like that can be a game changer, one for your care, and then also you spent potentially years saving into RSPs and tax-free savings account and building equity in your home. You don't want to then, in the middle of something like that, have to drain all those resources and then you come out the other end, yay, I'm clear and I'm healthy or whatnot's gotten better, but oh my goodness, my financial position is abysmal because I've just had to drain all these things I worked at, and now you're so much older trying to rebuild what would have otherwise been retirement funding. The next one is disability insurance. So disability insurance is related for those people who actively earn income. So for anyone who is retired, you don't get nor need disability insurance because you've accumulated the funds. So there's no income to insure against. So for those of us that are still working, it's looking at, well, if I all of a sudden can't work tomorrow, my income goes to zero. My bills, however, stay. Potentially they increase relative to what's going on in my disability. So whether that means maybe I'm not able to pick up the kids, how's that going to work? Maybe I'm not able to do all the things in the home and the cleaning in the kitchen, all that kind of stuff. I'm going to have to pay for resources for that. Maybe there's extra medication or parking at the hospital or all these extra things that come into play. Expenses quite often, relative to a reason for being on disability, might actually increase. So when we look at disability insurance, we're looking at what's your current income, what's your regular monthly expenses, and what amount of coverage should you have in place and for how long, so that if you can't work, you don't have to start looking at, well, we got to sell the house, sell the car, move in with parents, and do all these things. You want to give yourself breathing room to be able to figure out next steps on your term and not on your financial term if necessary. The fourth one I'll briefly touch on is health and dental insurance. So many people thankfully get health and dental insurance through their employers. Those are things that cover your prescriptions, your massage therapy, glasses, all that kind of stuff. Now, when you retire, those are plans that you can purchase on your own, and if you're self-employed, you can purchase them on your own as well. So depending on what your health situation is, that's often something that we look at to say, well, the hope is you retire, you're not already on a whole bunch of prescriptions, but you just don't know, and maybe there's a certain type of plan that makes sense so that should you have to start becoming on prescriptions, those prescriptions are then reimbursed back to you based on the structure of your plan. So with all of that insurance on you, is there any questions so far based on just the different types of insurance that I've just touched on? Awesome. Okay, sure.
Just one quick one.
Sure.
I was sick just as I was turning 65 or 64 and a half, and I was off on EI, and then I had to go back to work. When that was finished, I wasn't ready, but I didn't realize that I think you're 64 and a half, you can no longer collect long-term disability with some plans. So that was a shock when I'm still working 5 years later. So
There are the group plans. There are different definitions of what they classify, and also certain ages and stuff. So unfortunately, there are sometimes restrictions just based on what the plan is that the employers put in place. Yeah.
is that fairly common?
That one's not as common. Usually they go out to 65, and if anything, some of them will go out to up to 70, depending on the industry or depending on the type of person structure. There are some caveats, though. Unfortunately, for group plans, the disability portion of that group plan is the most expensive. So if they're looking to try and keep it to say, how do we keep a plan in place and keep it within a certain cost structure, that's probably the area they're going to have a lot of the wiggle room to try and reduce some of the costs. And logically, I'd say that makes sense to say the hope is there's limited people like, unfortunately, yourself, where they're going to be at that age having to go on a disability. So the risk of having that scenario come into play, and just unfortunately bad timing for the way their plan was designed. So from how insurance, in terms of the different types that there are, then it's a question of, okay, all these things are out there, they're all available to me. The big question is what actually applies to me. So what does any of that matter? What is that interested from? So for individuals here, who here is kind of, they are solely independent and they don't have any dependents, so no one's depending on them for, okay, awesome. And so then the rest in terms of maybe children or grandchildren or spouses or partners, okay. So there's a couple things to consider when it comes to insurance. So, and there are two different types of conversations. I would say for the individual that doesn't have a dependent, and that could very well be a spouse, but maybe they're financially stable on their own. So if something were to happen to you, they wouldn't be negatively financially impacted necessarily. That conversation is very less and little about life insurance, and it's very much of how do you maintain your own financial independence And quite often that's where we're looking at your critical illness or your disability insurance. So if I'm a single individual and you've got rent and car payment and lifestyle expenses and all those various things, I don't particularly care what happens to the financial picture when I pass away. I do care if I can't generate income. That's it. So what resources I have, you can pull from those, but how else do I get the dollars in needed to pay the bills, pay the rent, pay whatever else that comes up from that? And that's where you're going to be looking at critical illness and disability insurance to try and add in some extra support. On the opposite side of the table, I think, is more when you are part of a family and often you've got young children and a spouse, and your income quite often, especially in Vancouver, is necessary to keep things going. Then we're looking at, yes, the critical illness and the disability, especially if you're a two-income household. Life requires both of you to work to do everything in the home as you like it. Then life insurance becomes a bigger portion, because if all of a sudden that second income disappears, what happens for everybody else? So Tracy and I were just talking about this before. I love my husband, he's very capable, but if all of a sudden I'm gone, there's an income factor that needs to be replaced, and there's also a home management system that needs to be replaced. So I am generally the dropper-offer and picker-upper of children. I'm the sports coordinator. I am the food gets made and purchased and all the things, and birthday presents for birthday parties and all that stuff is something that just happens in our home. And if I'm not there to do it, someone's going to do it, and it's probably going to come at a cost. So there's the regular expenses that need to be managed, and there's probably some new expenses that would come along the way as well. So when looking at life insurance, it's not so much just oh, what's the balance of your mortgage, replace it and everything's great. It's an assessment of, well, where are you at in life? What is the cash flow? What are the expenses? What are the other resources and the net worth to draw from? For us, what are the age of the kids? How long might you have those dependents to keep going off of? What are you trying to accomplish? And there's a different number that's going to come out in an amount of life insurance. And that's all good in paper, and I think that's a great starting point for conversation. But I always preface with clients that I do two parts of recommendation. So we do all the needs analysis. We look at what everything looks like in terms of what do you have, who's involved, income, all that good stuff. And I say, here's an ideal recommendation for coverage, for life insurance, for critical illness, for disability. And often, just by the nature of it, the premium is going to be a sizable recommendation number, because that's often the amount of insurance that's not in place, so we need to start somewhere. I then do a second one that said, okay, there's only so many dollars that can go towards insurance premiums, so you need to be realistic. And we don't want to carve out that by paying for insurance, have no positive cash flow for savings, emergency fund, holidays, all the extra stuff. So then the second part of the recommendation is, well, what if we don't try and insure everything, but we try and insure a part? And what if we don't try and insure the entire length of the mortgage, but we insure a part? And then we look at your group benefits to see what can integrate into your group benefits plan to say, if you're an accountant or a lawyer or an architect, the likelihood is you're going to move from your firm, but likely to another firm that also has similar group benefits. So we can comfortably rely on that for today. So there's always a second consideration on, here's the ideal scenario, and then there's the more realistic scenario that also has to be considered, because there's only so many dollars to go around. So then I think it's important to think, okay, what are your numbers? And depending on how many people arrived in terms of timing, and I'll share it off before we head out tonight. There's a website, it's called, I'll share it now. If you Google Insure Right and Manulife, they have what I think is the best online insurance calculator. And I encourage a lot of clients to actually do that first before having a conversation with me. And the reason I suggest it is because then I'm not a part of any of the calculation. You are putting in the numbers yourself, and you are seeing what comes out as an outcome to that. And I had this with someone the other day where the call came into the advisor, who do I talk to? I need $250,000 of life insurance. And they said, oh, you're going to talk to Jacqueline. And so then we had a chat, and I said, I understand you want $250,000 of life insurance. He goes, yeah, my mortgage is X. I have this amount of life insurance through my group benefits plan. So the difference is $250,000. And he makes a sizable income, and he's got 3 kids. And I said, perfect. What about your wife? Does she work as well? She works 1 day a week. Okay, and what does she earn? X amount of dollars. Interesting. Do you mind, just for my personal awareness in terms of how I operate, can I ask you a little bit more? Oh yeah, sure, no problem. Suddenly go through it. And my recommendation note to him was that he needed another $1.5 million of life insurance. And that wasn't the $250,000 originally. The reason for that is 3 kids under 10, still a sizable mortgage, yes. If he all of a sudden disappeared, the likelihood of his wife still working that 1 day a week, I could imagine goes to 0. And then there's all the things that I said that I do all that stuff at home. Well, there's all these outside and extra things that obviously the husband and assist with as well. So if we were trying to offset his very sizable income for enough years to get the kids through university funded, keep up with the RESP, still accumulate the savings that would needed to be had for retirement savings and such, and then also recognizing that that's $1 of today expenses, but inflation likes to make all those expenses increase over time. That's the number we got to at the end. And as I then walked through the justification for that, oh yeah, that's really ridiculous that I would think that we only needed $250,000 to pay the mortgage because if the house is paid, they still need to eat. Exactly. So the reason I share this calculator is if as you go through and put in your numbers, you will see what the outcome is. And you might be very happily surprised to say, oh, with what I have in place and when I get through my employer, I'm good to go. It's staying a little bit, but I'm happy to take the risk on myself. Or you might find, oh, that's a number I wasn't expecting, and why? Did I enter in something wrong? Maybe that's not the case, or maybe there is a conversation that should be had further just to see what makes the most sense for you. Looking at all those products, that calculator for awareness, it's with Manulife because I think it's the best calculator. I'm not saying that you specifically need to do any insurance with Manulife. I'm not saying that's the right product for you. There's all these little intricacies that based on your health and your situation and what you're trying to accomplish long term, there's various companies, there's various types of kind of finagling that you want to look at the contract. But from a starting position, just to get an awareness, that's why I'm recommending that as just an online activity for you, if you will. In saying that, when you go through that and you think, oh, do I need to have insurance? Should I be talking about insurance? Whether it's with me or with Tracy or with Aaron or somebody else, if you already have someone that does insurance advice for you, or you're introduced to, inevitably everybody gets introduced to somebody who just got insurance licensed or just got into financial services, and everybody starts doing that. I know I started it one day and I had the same thing. Mom, Dad, can I practice? Nana, Papa, can I practice? Everybody's parents, friends, can I practice? I've got to learn. So that comes about. There are questions to ask advisors, and whether you know they're new or whether you know they're experienced, I still think it's important to be armed with the right questions to go into those conversations to say, how do I know you're acting in my best interest and not just your best interest? Because in awareness, for the most part, insurance is sold through a way of commission income. So if I sell insurance, I get compensated. If I don't sell insurance, I don't get compensated. And so you have to be working with someone who can do that appropriately and isn't operating from a desperation, for lack of a better word, but from in a position to be like, I know I'm giving good advice, and whether you take it or you don't, that's okay with me. I'm not struggling to pay the mortgage on this one conversation. I think that's an important position for the person that you're speaking to be able to have that level of autonomy based on their recommendation. So I put some questions together so that you're aware if you're having that conversation, what should I ask of the person I'm speaking with? So things that I would consider important would be, how long have you been doing this? And there's no reflection of the type of person if they're brand new to the industry, but I know what I now didn't know when I first started, and there was no reason I should have been talking to people alone. I was perfectly fine and licensed. I think I had a leg up just based on how I was educated as an individual with my family, that I probably knew more than most, but now knowing what I know, I did not have the wherewithal to talk to business owners about their corporation and taxes. I did not have the wherewithal to talk to individuals and properly assess their group insurance plan relative to other insurance policies and then figure out what makes the most sense with their RSP and their tax-free savings account and really dive deep into that. I didn't have the awareness to say, you should pick this policy over the other specifically for you because of this one little caveat that actually matters to you because you're a backcountry skier, for example. So it's all this other stuff that naturally, it's no one's fault, they have to start somewhere, but you shouldn't have to be the bearer that they're learning on. So finding out some awareness, and that can often just be covered by, look, I appreciate you're new. Do you have any senior person that you're working with? I would really appreciate talking to both of you. And that might be one kind of barrier removed by just getting some extra senior assistance on that. Another would be how they operate in terms of what types of insurance companies they look at. So for myself, I work with, I think we're over a dozen of the main national, most of them are publicly traded insurance companies. When you're purchasing an insurance policy, you're talking about a decades, multiple long decades commitment. If you put your money in today, you want to know that it's going to be around 50, 60, 70 years from now. I've got policies I purchased on my kids at 1. I need the company to last at least 95 years. So when you're talking to advisors, what kind of companies they work with matters. And not to say that advice can't be valuable from those people, but I would be cautious at working with people who can only sell one insurance company. Because if you are a tool man with one tool, every job will need that tool. And it's just not the reality that that one insurance company has the best product on all aspects for every person. So I think, like in everything, variety and options, and how do you really fine tune and tailor to yourself. Working with someone who has access to different insurance companies, different insurance products, isn't incentivized to sell one company over another. It's like, here's everything on the table. As we learn more about each other and you figure out what's appropriate, we get off the stuff that doesn't make sense for you until we're finally left with the things that do actually apply to you. If I only have 3 options for you, well, guess what my recommendations are going to be. So I think that's important to find out from the person that you're speaking with. Another is in terms of servicing. So insurance in general actually has bad opinion, and I think it's rightfully so, and it's been coming up in the news lately, and there's been some articles about it. It's all fine and dandy to meet someone, have your meetings, there's really good communication at the beginning, you buy your insurance policy, and then see you later, and that's the end of it. And the problem, and it's a built-in reality, is that for the way that insurance people build their business, they sell the policy, that's how they're compensated. And for the most part, there's really not any compensation. There's kind of dollars and cents that come after that. So kind of speaking to who are you talking to, what's their motivators, you're looking for someone who's in it for the right reasons, providing service. And so finding a clear understanding of what it is they're expecting, or what it is that they're offering in terms of their servicing. So if you call and ask for things, are you going to talk to them? Or do you have to start calling the insurance company and deal with a 1-800 number? Bless you. A 1-800 number, which nobody wants to do. Are you dealing with someone who they sell you the insurance, and then everything after that you're going to deal with their admin associate, who might very well change every 6 months. You never really know who you're speaking with. And you're going to have to keep rehashing, this is who I am, this is my situation, every time there's a review. So I think that type of awareness on what your expectations and what you want out of that person. It also really helps, obviously, if you're working with an advisor, that gives you an extra level of support, because now it's not just the one insurance person, it's the advisor as well. And for people who have gotten into financial services, whether it's insurance or investments or mortgages, it's tough. It's not an easy career to get into, especially as it's all commission driven. So like many things, there's a lot of people that start, there's not a lot of people that make it past year 1, 2, 3 onward. And so when you're speaking to someone earlier in the career, it's harder to guarantee that you're going to have them still working in that industry, able to service you many, many years down the road. And so that's where, if you've got it part as a team and you've got some more seniority as part of the team, you can be more confident that the servicing, whether that's that individual or the team, is going to be there long term for you as life changes, as you have children, as you purchase a new home, as your career changes, as there's a divorce or someone passes away. All those things are part of life, and so making sure that you have someone to rely on for when that stuff happens is important. One thing that keeps people away from insurance is this notion that they don't qualify for it for whatever reason. And often it's an overinflated concern because they heard something from somebody and they were either denied a claim because of this little thing, or they weren't able to get the insurance because, oh, they have high blood pressure, or my dad had cancer and so I can't get insurance or my premiums are going to be so high. And a lot of the times it's not accurate at all. When it comes to applying for insurance, naturally your health matters. So if you've just been diagnosed with a critical illness, well, no, we're not going to be able to get you insurance for the most part. If you are on a slew of medications and doctors are still trying to find out how to help you get better, we're probably not going to be able to get you insurance. But for the most part, if you are stable in whatever condition you have, so medication has been figured out, you're able to work, so if you had been off work but you're now able to work again, not that you have to be working, but just that you could, there's a lot of options still available and on the table for you. So there's not a reason to kind of pre-disqualify yourself just because you think you might have a problem. I think it's helpful to go through the mechanics of, do I need it? What should I have? What's most appropriate? And then does it even work for me to purchase any of this or qualify, and what might that look like? So for some people, that might mean a nurse has to come visit. Generally, they're quite nice. It's a quicker appointment, so it's not hours or something like that. They go through medical history in more detail. There might be a blood or a urine sample. Very rarely do you need like Holter monitors and anything extra than that. And if you are younger and you're not applying for millions of dollars of insurance, sometimes none of that is actually required. Sometimes it's just, we have a Zoom call, we go through an application, I ask the medical questions, click submit, and that might be the only work on your part, is just to tell me about your family history. And so I think with that, clear communication so that expectations are there, awareness that if you do have some health challenges, yeah, your prices might increase depending on your family's history of, for example, colon cancer or breast cancer. You might have a higher cost on a critical illness policy, just because the nature of that is that you have a higher risk associated with that type of health situation. So it's being clear coming into it, but not to say that just because you don't have pristine health and you're not an Ironman or triathlete or something, that you can't qualify for normal, affordable pricing. Given I've now continued with a whole bunch of information, is there any questions that have come up so far? Any notes that you've made? All good? Oh,
I
sure.
have a question about
Sure.
something you had mentioned, which is buying insurance for children.
Mhm.
You said you had bought insurance for your child at the
Yep.
age of 1. Can
Mhm.
you explain that, please? How that works for, at what age should people be looking to buy insurance?
So I think on a hierarchy, you need to take care of the parents first. So parents would have all the insurance they need, and then I would say that there needs to be a certain comforting cash flow to like cover your retirement planning in terms of like, can you save it to your RSPs, are you contributing to your TFSAs? The cash flow is a comfortable position. And then I look at child insurance as a complement to all the other work that's being done. So I think the parents and the financial security need to be met, and then we can look at all the extras that might make sense. So with children insurance, there's 2 areas to look at. One of them is life insurance. And most often, at the beginning, I talked about that whole life insurance, and it has to have the right job at the right situation, and kind of all the things have to align. Children whole life insurance policies is one of them. The reason being, for children, the premiums are just the lowest they're going to be naturally. So the younger you are in insurance, to a degree, for children, it's nice and low. The way that whole life insurance works is you set a premium and you start with a certain amount of life insurance, and then every time you make the premium payment, the amount of life insurance increases over time. So if you're trying to think about something with inflation protection, $50,000 or $100,000 now won't mean peanuts to them when they're 75 or 80. It'll actually continue to grow, likely actually to exceed inflation and have some value there. And the other component about that with whole life insurance is there is a building investment component. So it's almost like buying a house on a really small scale, where you have to pay your mortgage premium every month. So you pay into this insurance premium structure. Most of the time, 20 years is a time frame that's quite common. So you pay that for 20 years. After 20 years, you as the parent say, okay, contract is done. You don't have to put any more money in. The equity in the insurance policy has effectively grown, so there's this investment component to it. So as a complement to any RESP savings that you've done, you've got your RESP money for education. If you need more, you might be able to then pull out of the insurance policy. Or if the education is done and now you're looking at more, well, how do I help with a down payment on a property, or there's a wedding coming up, or they are looking for funding to start a business because your child is entrepreneurial, there's another reserve of cash that can be taken out of the policy to assist with that. Or none of those things happen and you say, okay, you're now a mature, hopefully adult, responsible, here's the policy. and there's no dollars that have to go in. The pot of investments in there will continue to grow over time, and at some point in time, should they need the access to the funds, it's there. Or you might have just saved them the need to have this conversation that there's the amount of life insurance they need as an adult, premiums are paid, it won't affect their cash flow, and they now have it for their family. So that's the life insurance part of it. The other side is critical illness insurance. So we looked at it as a risk component for my husband and I to say, if one of my children got diagnosed with a critical illness, I won't be answering my emails and taking meetings the next day. I'll be with them in the hospital doing whatever the case may be. So we actually wanted the extra coverage on them to say, well, our income would be impacted. My disability wouldn't pay out because I'm not disabled. My critical illness wouldn't pay out because I don't have a critical illness. My life insurance wouldn't pay out because I'm still here. Where does the money come from? It wouldn't be any of my insurance policies, but there's still a financial risk to having a child who's now sick. So we purchased insurance for critical illness on the kids, and that has a twofold component. One is that protection for us for income, and then the second part is the type that we purchased once they become 26. At 26, we get all our premiums back, so that's the hope. I hope that they have no claim. I hope I get all my dollars back from my policy, and they are guaranteed to be able to now purchase an adult policy equivalent for the same amount. So regardless if they had some sort of health challenges, maybe not a critical illness, but maybe it does affect their ability to get coverage, they're guaranteed to get it regardless because we've got that policy in place ahead of time. Which, oh, sure.
Can I find life insurance and critical illness insurance for my adult child?
Yes. Yep, you can buy policies on children I work with a variety of clients, so similar to Tracy, kind of the entire spectrum. I've got clients right now where they have sizable wealth and they're purchasing sizable policies for that scenario on their adult children, where they're just coming out of university, for example, and they just want a way to move wealth from under their name into their child's name, and also protectionary measure to say.
But do I have to let her know?
Oh, yes, you do have to let them know. So as a child, you can purchase insurance on their children, and that is you. As an adult, nobody can apply for insurance on another adult without their ability. They don't have to pay for it. They don't have to own it. But they do have to say, yes, I'm acknowledging insurance is being purchased on me. And then also they might have to be part of the blood sample or urine, depending on what's being applied for. Yeah, it is very common, though. There's a lot of wealthy individuals who they have all this wealth. They know they're not going to utilize it in their lifetime. They are going to transfer it eventually to their children or grandchildren. And there's a lot of tax efficiencies and estate planning work where we do want to move money from one generation into the next, ultimately out to the third. And so insurance is a very tax efficient way to do that. Other questions, again, speaking with the advisor, would be what type of families or individuals do you work with? So there's a lot of particular information surrounding very different financial positions. So especially if you're working with really high net worth, if you are yourself someone who has higher net worth, or if you own a corporation, or if you operate a business, that's a really different line of thinking and conversations and context than someone or a couple or individual works, earns income, saves some, but is kind of more on a cash flow month over month. So for more complex scenarios where there's more dollars on the table, where there's a business, where there's a mixed family, so there's children from one or two individual parents, and so now you have mixed considerations, blended families are becoming more common. And then when you add cross-border challenges, so if anyone is not just a Canadian citizen and they've got citizenship elsewhere, all of that adds different levels of complexity. And back to when I first started not knowing what I didn't know, nobody knows that information. It just takes experience to get there. So when you're speaking with whether it's a investment advisor, financial advisor, insurance advisor, you want to ask, do you work with people like me? Give me some examples. What are things I should think about? Because for people in any sort of sales position, I work with everybody. Yeah, I've got it. I've got all the experience. Well, give me some some awareness that you truly have had this experience. Like as a U.S. citizen, what scenario should I think about if they're not mentioning things like, oh, you have a special tax as a U.S. citizen to buy insurance, and actually you can't buy all the insurance because some of it doesn't work for tax purposes with the IRS. If someone hasn't done that type of work, they probably aren't familiar with it to bring it up. For blended families, insurance really integrates with the trust and estate planning, because when you've got a mom with a child and a dad with a child and they marry and coexist and everyone's happily ever after, that's fantastic. Unfortunately, if mom passes away and says, okay, everything's going to go to my husband, that's what's normal. Most people, everything goes to the spouse and everything gets taken care of. Unknowingly, they might not realize that, well, you hope everything is perfect and rosy and great and continues onward, but you could have effectively cut out your biological child from every single item that you own. And unfortunately, there's nothing to correct that after the fact. So in some scenarios, that's a will, an estate, and a trust planning conversation. In other scenarios, that's very much an insurance conversation, because I would look at that and say, well, the home that you two jointly own, rightfully so, I would expect, your husband and your children would live in. If that's the bulk of your assets as an individual, that's not the right or the wrong way to do that, but what else can be done? And so that's where you can say, okay, RSPs and home go to my husband for the purpose of my family, but as an extra caveat of protection, my $500,000 or $1 million of term insurance, at least while they're young, goes directly to my child. And then it's not accessible, it's not to be muddied and mixed in with other things. It's very much clearly for the intended purpose of, I just want to make sure that my child or children are taken care of. So there's extra considerations where insurance and your will and legal documents and your estate plan really do have to marry, particularly in British Columbia. So in British Columbia, we have the Wills Variation Act, and there are very set rules on what's allowed, what's not allowed, how multiple children and mixed families and different generations and access to your estate can try and get their fair share. And it's just so much easier to have that conversation when you're here to give what your wishes are, because if you have wishes, and they might be very valid. So if you have 3 children and you love them all, but maybe 2 of them are more helpful and deserving of certain dollars than others, and maybe that third one might also be lovely, but they have a money problem or drinking problem or who knows what problem, maybe it doesn't make sense for them to get a third of a $3 million place on the North Shore. Maybe it makes more sense for child 1 and 2 to each get their third, and child 3 to get a monthly income so that they can blow per month, but they can't blow $1 million in a year or 2, which I've got clients like that where they kind of test out their kid. They've given a couple $1 million, and it's incredible to see how fast it disappears. And so even though there's more money to replenish, naturally they don't want to keep replenishing the pool that keeps getting drained. So that's a different type of conversation. And when we add in insurance, it's a way to look at, if it isn't related to a property or a family holiday home or something like that, where's the liquidity? How do we balance out with everything on the table? And real estate's harder to divide, so how do we come up with the equitable amount of cash to just make that part of the conversation a little bit more fluid and faster to handle? Other things that I think are important to note are who is the beneficiary of a policy. So for any of the living benefits, you are typically your own beneficiary. You get the money based on your health situation. Life insurance can run the gamut. So quite often, if you are in a typical spousal relationship, your spouse will be the person to be the beneficiary on your life insurance policy. If you have children and they are minor, it depends on what you're trying to accomplish, but I generally recommend, assuming that there is kind of like all biological within the same family and that you don't have cause for concern, that your life insurance would actually go to your estate. And normally that's not what you would do, and the reason for that is life insurance has this nice thing where it flows directly to the beneficiary. It means it doesn't go through probate, which costs 1.4%, so for $1 million that can get pricey. Probate also takes time, so someone passes away, you have to apply to the court for probate, and that could take a year or 2 to settle if you're lucky and it's not super complicated, which is obscene, but that's the reality. And so if there's some extra care and protection and it's properly structured through your will that there's care for the children. The reason I suggest putting it through the estate intentionally, if unfortunately both of you and your husband were to pass together and now everything's going to minor children, is that you don't want to create two trusts. You don't want to create a second pot of life insurance for your proceeds for your children that upon them becoming an adult, they immediately get access to that cash, potentially in a lump sum. There's no 19-year-old, in my opinion, that is going to be a great decision maker with $500,000 or $1 million. You're going to want more structure in place for that. So if you move it towards your estate, your will, hopefully with the right drafted direction, will say, okay, obviously cover all the education costs, help them as necessary for a reasonable car, give them some sort of income to help for university and stuff, but maybe they wait until they're age 25 or 30 or something, or someone has some discernment on when they get the bulk of the value from that. Outside of if you're talking just about your kids and your spouse and maybe you don't have kids, and so if something happened to you and your partner, then what? Then you're looking at whether it's your parents, whether it's siblings, whether it's charitable giving is another big component, looking at different charities that mean something to you. It's all just a contemplation on you've amassed wealth, insurance would be extra to that, and where do you have priorities, and then there's some tax efficiency. So it's walking through that conversation, but it's identifying where you would want funds to go after the fact.
So with kids, so there's a single parent, need to insure that parent, 2 kids, about, 7 years old, let's say. You wouldn't do a life insurance policy with the beneficiary being the guardian?
So you wouldn't name the guardian as the beneficiary because that means that's their money. But you could name your children as the beneficiary and then put the guardian as the trustee of that money for them. It depends. So personally, my brother is named as the guardian in my will of my children, and my life insurance goes to the estate because I know my brother is in a financial position that while my estate and my husband's estate would be being dealt with, he could cover the costs of taking care of my kids and then balance out after the fact. But it means that I've got one estate plan, one trust, minor trust for my children, one set of directions. If I had otherwise laid it out that my home value and all the things go into the estate and then follow the direction of my will, and then if I put my life insurance as my kids with my brother as the trustee, that's a secondary trust, which insurance policies just don't generally have the amount of detailed direction you can give them. And so my brother would be able to access the capital for my children in care for them, but come their age of adult, they would then have access to whatever the amount is. And because of what I do, I know I'm overinsured, but there's a lot of money that would be there if something happened to me. They wouldn't need that access to capital then. So it's what's your individual scenario, like all of this. There's general awareness, and then there's what's your specific situation.
But if you make do you mind if I ask this question?
No, please.
So if you make it the estate, but the person, this is a scenario we're working with right now, but the guardian who's fully capable of looking after the children does not have the financial to be able to support those kids for a year.
Then it's what your whole estate plan is. So depending on the situation, you might look at I'll use $1 million because it's an easy number. You might give $50,000 to the guardian, and you can split up the beneficiary on your life insurance policy. So you can say, okay, here's a certain amount of cash that goes to you as the adult because things are going to be expensive. You're going to need to move my kids maybe from one home to the other. You might take some time off work. You might need a bigger car. My brother's got 3 kids. If he has mine, he has 5. Their van, I don't know what they would drive. Like there's a lot of extra components. So you might say there's a portion of dollars to go directly to the guardian upon your passing, and then leave the rest of it to the estate to then follow the direction there. So again, it's all that fine tuning on what's your individual family need, who's your individual guardian, did they live in country? You've got some people who they are the first of their families living here. There's some really horrible and it's sad scenarios where you've got grandparents who are supposed to be the guardians of this child who was born and raised in Vancouver. The mom's parents are supposed to be the guardians. They live in Japan. The dad's parents are not supposed to be the guardians. They don't want to be the guardians. They can't be the guardians. They want to make sure the children can get to the grandparents in Japan, but the legal documents weren't in place. So trying to work with BC courts to get a Canadian citizen child minor out. It's been, I think, a year and a half or 2 years of a horrible situation just because the paperwork wasn't in place. And so you don't know what you don't know, and you don't expect that stuff to happen, but it's the reality. And so that's where it's, what is your specific situation? Because it's easier if your important people are here, but if they're not, now there's extra levels and extra steps of conversation to be had.
Also easier to have rich guardians.
Yes, that, unfortunately.
It's just easier to be rich in general, right?
Yes, sure. If you have no money issues, then it's just like money flows all over. I mean, that's my best advice. Be really rich and have rich family and friends, and then it's all easier. Not being the reality necessarily. That's where all those extra fun conversations come into play.
Yeah.
Sure.
What kind of insurance would a spouse get to insure spousal support?
Oh, that's very common. That's a common conversation I have. So,
Repeat the question.
oh, sorry. So in terms of spousal support, insurance to protect in terms of if someone's supposed to provide you spousal support and they pass away, the spousal support disappears as well. So for most of the cases I deal with, it is a court-ordered requirement for, assuming that there's not enough assets in place right now to cover it, it is very common for the court to say you need to have the equivalent of, say you're going to have to make $2,000 a month for 10 years of spousal support or child support payments, whatever the equivalent total dollar value is, you need to have that in life insurance, and you have what's called an irrevocable beneficiary of the ex-spouse. So if you purchase a life insurance policy, you name the beneficiary, at any point in time you can change that, nobody has a say in it, except for if it's called an irrevocable beneficiary, and at that point, the only time you can change the beneficiary is when that person signs off an agreement that yes, you can remove me as the beneficiary, and that's the one time where I would say that's where you're gonna want it because, and I'm dealing with this right now, you get the court order arrangement, and if the person who you're dealing with, maybe it's like you phone into the insurance company, quick do this and this, and they don't have enough on the background of where it's coming from, they process it, and then you as a normal individual look at it and go, yeah, policy, there's my name, we're good to go. If you don't know to look for irrevocable beneficiary title, you don't know that when your ex-spouse, who ideally is a great father, but maybe not a good husband, finds a new girlfriend, your name can very easily be removed off the beneficiary list and replaced with any other name of the month as intended. So that's very specific detail work that you want to make sure is in place if that's the scenario that you find yourself in.
So if the person has enough asset, if he has asset, then there's not necessary to have this court-ordered insurance. Is that correct? Then it would be like from his estate.
It's less likely to be court-ordered requirement to have the insurance if that's the case. Now, as the person on the other side of that, if that's my ex-partner who's supposed to owe me these funds relative and the court's not ordering the life insurance, well then you need to be familiar with the estate structure to say, is there some sort of trust ownership or trust arrangement in place to make sure that I am now going to inherit the equivalent dollar value. So it really depends on what the spousal or income and child support income arrangement is. Some will have certain wording that the residual amount owing will be removed first before any other division of assets related. There is the Wills Variation Act in BC, so if it's their biological children, they should be due a certain amount of the overall percentage of their assets. So there are some protectionary measures in place, but again, like all of it, it's easier to get stuff in writing, formally done before anyone is sick or passes away naturally. So some arrangement of what does the will look like? Is there any trust planning? Is there insurance in place? And then there is also a capacity where some people just suck. And so, right? That's the technical term for it, right? So if there is not a court order, but you have an awareness of the person that you are no longer in a relationship with, and you go, how do I protect myself and be self-sufficient? They might be open to allowing you to purchase insurance on their behalf, so you are incurring the premium cost, but you are protecting your self-interest in saying, over the next 10, 15, whatever years, it's hopefully a smaller amount of premium that if something were to happen to them, you are the owner, you are the payer, they are the insured only, and you are the beneficiary of the policy that you've purchased. And now you have guaranteed the fact that if they all of a sudden pass away, regardless of what they've done on their side, if they've blown all their money or they've sold all their things or tried to do some nefarious accounting work or who knows what, and you're not getting what's due, at least you get the life insurance that you're due, that you've owned and controlled. They have to agree to that, but usually at that conversation, if there's children involved, they don't have to put up any money and they don't have to do anything. Hopefully, it's just going to be based on individual situations there. Couple of things when I will say it out loud, insurance doesn't solve everything and not everybody needs insurance, and insurance isn't always the right place to start, and I say that as an insurance person. So some scenarios where insurance should not be the start of your financial planning would be if you are still struggling on a month-to-month basis to manage all your current lifestyle needs in terms of groceries and cars and kids' activities and all the things, and you started a new career or interest rates on mortgages go through the roof and nobody planned for that, that is not the time to take on another payment. Now, the need might be very much high, and so that might be the exact time where it would be appropriate to have all these insurances in place, because if it's tough now when everyone's healthy and working, imagine what happens when someone's not healthy and not working. However, you need to have a regular ability to make your premium payments, and I don't think insurance should make it harder for you to get through each month. So there should be a certain level of cash flow comfort where you're able to save on a regular basis and not have to now deplete the savings that you've accumulated over the last couple of months to be in the position to now commit to this extra sort of premium payment. Another one to consider is just what you're trying to accomplish. So if you are 62 years old, it is unlikely that disability insurance, one, you can't qualify for it, but it shouldn't even enter your mindset, because the risk that you have for the last couple of years, hopefully, the amount of premium that you would have to pay on, for anyone actually over age 55 on disability, the premiums really do get quite high. Generally, hopefully, you're at a position now where, based on other savings, equity in a property, everything else, maybe you've inherited something from mom and dad, the hope is that you'd be able to figure out a way with everything else, and that the best use of those otherwise premium dollars would go to continue to build up your RRSPs or your tax-free savings accounts or something like that. Another one would be country of residence, because that matters. So when it comes to any of the living benefits, or when it comes to term life insurance, those pretty much have a no borders policy. You can start here, and then as is common lately, people are doing a lot more sort of online businesses, or they're working from their laptop and they're traveling the world, which is fun. You can purchase the insurance here. You can be a Canadian citizen or a permanent resident, and then you can pretty much go anywhere. And the only caveat for getting the claim done properly is, naturally, if you pass away in another country with a different language and the doctor and medical care is in a different language, it might be more challenging for the insurance company here to sort through it, but they can make that work. The biggest hurdle would be if you're diagnosed with a critical illness or a disability now in another country. So the caveats there are that you're getting proper medical care. So you have to be under the treatment of a doctor, and you still have to fulfill the test or the requirements of if you were in Canada. So if you're in like the middle of nowhere in Papua New Guinea, that's going to be harder to make a claim because you're not going to have this, like, the required care. If you're in Munich, probably not an issue whatsoever, and off you go. The only hurdle really in terms of planning for people who are going to move back to where they came from and they're going to move to another country, a lot of the conversations I have are people moving back to Europe or people moving back to the States, or that's where they intend to be because of other family, is when you have life insurance policies that have that built-up investment component. And the factor there is that all of a sudden now we have a tax event that's going to happen if you take this asset, because there is investment in there. And if you move this type of policy and you kind of leave your residency and you leave your tax status in Canada, is to be aware of that there's going to trigger a taxable event. And depending on what the overall picture looks like, that might not be any more attractive for what you're planning for. So if I'm talking to a business owner and they're generating positive income in their business and all these things make sense, quite often that type of insurance policy makes sense. But if they then tell me that their 5-year plan is to move to the Caymans, that conversation ends there, because that's not the right structure for them long term. One of the things I don't know if I mentioned it earlier, and Tracy and I were talking, is in terms of the online information available for people to consume information. So people consume information on like TikTok and Instagram, and it's really good to get like a 15 or 20-second blurb about something. The danger of that is so much of the content is actually geared for people in the US, so the rules aren't the same here. So we don't know where the content's coming from, and so it sounds good, but it doesn't necessarily apply to us. And then the other factor is that the people who are doing that type of content online typically have no requirements to tell the truth or give all the disclaimers necessary or say how that comment could ever come into fruition. Some of the things I hear about being your own banker or how do you get free insurance or things like this, it sounds really good in a quick little clip. But like the stars would have to align and the unicorn would have to like flow through and all these things would have to happen for that to ever be possible, but it sounds really good. And then I get people to say, oh, I saw this thing online, does that apply to me? And then one, often no. Two, it's not going to do the job you think it is. And then three, the terminology is always funny. So the biggest thing that I hear about online is to be your own banker. And that's related to this thing called whole life insurance I mentioned earlier. So you put money in, you grow the investment, and then the theory is you can borrow back from it. So you don't actually trigger any tax because you leave the money there, you just borrow from it. So you kind of create this line of credit with your policy, if you will. And it makes me laugh because to do that and not trigger a tax event, you actually have to go to the bank to get a loan on your life insurance policy. So in theory, all these things exist. It's just the advice and the way that it's described is really oversimplified and confusing. And so I think when you're trying to get information on insurance policies, which is already a confusing topic with all the options out there, is to make sure that you know, one, who's sharing the information. So if you're looking to get more information, I would suggest accounting firms and insurance companies are going to be your best bet for reliable, Canadian, appropriate, honest information. Finding obviously the people who do this for a living in Canada, that would be another one. And then recognizing that some of the recommendations, because they're online, for example, from an insurance company, they always paint naturally the rosier picture of, oh, grandparents passing money on legacy built to wealth, and it sounds great, but then you've really got to take a look at what am I personally trying to accomplish? Does that actually apply to me, or does it just sound good and I'm thinking it makes sense? So you really just want to narrow it down specifically for your own personal situation.
I was telling Jacqueline that when I'm having a grumpy morning and I'm in all these networking groups and I'm online, I'll just spend the first 5 or 10 minutes of the day looking at all these things going, what are your credentials? What are your credentials? What are your credentials? There's no end. What are your credentials? What are your credentials? I can get to 20 or 25 and I've like done a little bit for the world, but it's just like there's still hundreds and hundreds of people that call themselves financial therapists and, you know, your banker.com and all of these things. And you just see in one of them there was and she wrote back, she says, I'm a licensed financial educator. I said, that credential doesn't exist. Like it doesn't, it's just not. I checked, is it in Croatia? It's not, there's no, like, I'm a financial educator who has credentials. You are not. So going through and just like, and they don't even know what Jacqueline's saying. That's not that it's not bad people preying on you. Let's say it's not. They simply are so ignorant of what they don't even know. And they're out there with, you know, they've got whatever it is they're trying to sell or, you know, and I just assume they're people who are trying to feed their families as well. I don't have, but they are dangerous because of the amount of ignorance that they are basically spreading all over the place. And one of them, this licensed, she had 150 women were like, I want in. I counted 150. And I could have started and I would have been there until lunch hour going, don't. It's just like, and it's like 65% of people under 35's people under 35, 65% of them are exclusively getting their financial education now from TikTok.
It's
TikTok.
Horrifying. That's kind of most of what I want to chat about in terms of just summarizing. That's a good point to make. I think there are a lot of professionals in what they do, and the financial services industry is very muddy. So part of my work on the Board of Advocates is we work for title protection. So what that means is trying to find a way to make it clear to people what all these random titles on business cards mean, because right now anyone can call themselves an accountant. You do not have to have an accounting degree, which is terrifying. Anyone can call themselves a financial advisor. There is no license of a financial advisor. So I can call myself a certified financial planner because I have my CFP, but anybody can call themselves a financial advisor or a wealth manager. There are all these very titles that look very nice on a piece of paper on a website, but unfortunately it means nothing. And so for you to have scrutiny going into these things, it's unfortunately very easy to have a nice office and a nice outfit and a nice car and talk really well and sound really great. The experience and the credentials coming in to actually offer you the appropriate advice is harder for you then to pick out. So things to look at are, one, credentials are important. So what have they actually gone to school for? What are they licensed for? What can they sell you? So something as simple in my world as insurance, if someone doesn't have an insurance license, they actually can't talk to you about insurance, which there's a lot of investment advisors who will go through and then they'll say, oh, you need X amount and go to your person. They had no bearing to have that conversation because their expertise is the investment field of it. I would never make an investment recommendation. One, I have no idea, but two, I'm not licensed to do so. So I'm not the person to do that, even though I could probably make a compelling case on why you should buy certain companies and certain shares. That's not my area of expertise. I'm not licensed for it. I'm not insured for it. I'm not anything for it. That's for somebody else. So I think when you're assessing what type of advice and professionals to bring in for your situation, one, it's daunting, but it's an awareness that one person is likely not to do the job. So your accountant is not your only professional at the table. Your lawyer is not your only professional at the table. For the most part, for most often, your investment advisor is not the only person to provide you investment advice. So it's finding your good lawyer to talk to about a will. And I will say lawyer, not notary, and it's not a fault of any notary, but when you often go to a notary, you're going at with your request and they're fulfilling their request. What you really want is you're going with your situation. You want someone with the right experience to ask you questions and provide you advice to then have a conversation about and then make an agreement about so that it fits in with all the legal requirements in BC. So your accountant, your investment advisor, your lawyer, your insurance person if you have one, your mortgage broker if you have one, your realtor if you have one, all those people at some point in time, there should be some communication across all of it. And I'll think about why wouldn't one of those people wouldn't want to talk to the other version. So if your accountant goes, I don't need to talk to your investment advisor, I don't need to talk to your insurance person, why wouldn't they want to engage with that person? Is there anything that they just don't feel comfortable speaking about? And I love accountants and they have definitely their place at the table, and I say that as like both my parents are accountants, I got respect for industry wise, but accountants are like doctors, and so you would not go to a foot doctor for brain cancer. With accountants, you have to go, what type of account? Well, first you got to start with, are you actually an accountant or you just call yourself one? Do you have a CPA or CA? And then what type of accountant are you? Because there's your audit accountants and your tax preparation accountants and then your planning accountants, and then there's all these other accountants. And if you own a business, there's your corporate planning accountant, which is such a different conversation. And almost all of them will have no insurance experience because they're not insurance licensed, because they don't need to be. So there's all this intricate conversation work that should happen that naturally won't happen if you unfortunately don't drive it yourself. So it's just being armed with what are you looking for, and you're going to have to be the prompt to your different variable professionals and advisors to kind of spur those conversations together.
It is tough. Like it's like trying to pick a doctor. Yeah. I don't have, like, if you don't have medical knowledge, how do you know who knows? I had a red spot on my cheek about 6 or 7 years ago that bothered me. I went to 5 dermatologists. And I got everything from this is a life-threatening illness to this is just a really weird form of rosacea. Not one of the 5 diagnosed the same thing. And it really gave me pause about just professional advice in general. and having checks and balances. Like, we don't do tax work here specifically because we think there's a check and balance, and having an accountant look at something with a fresh set of eyes. We're not frightened of it. We think that's a great extra piece, you know, in somebody's situation. So it is tricky. I have sympathy for everybody in this complex, you know, in this complex field.
So with that's kind of my final thought, is that a lot of it, you just have to take ownership, obviously, of your own financial position, feel very comfortable asking questions, and for the most part, everyone in this type of services industry, in the financial side, openly has conversations. And outside of the lawyers, but even then, they will generally have initial conversations with you. And if you Google, like, what question should I ask my X type of professional, go in with some questions and see if you like their answers or not. Some you can ask, like, do you work with anybody like me, my situation? Would you mind putting me in touch with them? I would just love to hear their experience. Some people have that, some people don't, for privacy reasons. Obviously, it would be challenging, but a lot of the accounting firms will let you know some other people that they've worked with if you're a similar business or something like that. And then also, just there's a factor of just going with your gut feeling. So if the answers might all sound right, and it might all look right, and online they might very well have the designations they're looking for, but if at the end of the day you don't feel comfortable to go, I really feel like I can open up to this individual and tell them about my health history and my husband who maybe I don't want as my husband forever, and this scenario, and my son has a drinking problem, or I love my son but his wife's, that might not be a forever relationship. You need to be very comfortable having some very uncomfortable conversations. So if you don't think you can do that with that person, maybe they're not the right person for you. That's not a knock on them. It's just you might need something different. And so I think just being comfortable to make those choices as you go through and trying to plan out your situation is important. So that is it, unless you have any questions. Put you to sleep.
You've recorded this?
This has been recorded.
We'll be able to, there's a lot to unpack.
The
Ready for bed?
The exam isn't until next Monday.
Make sure you're right there. She'll ask it.
So you look like you had a question. Are you
No,
figuring
I was
it
just
out?
thinking that you're like the Oprah of insurance.
Oh,
And you get a policy and you get a
yeah, that's good.
No, it's been so eye-opening, like I
Yeah.
had
Oh, good.
no idea about 90% of what you just said, and I thought I knew. So I think that's really, now the question I did have is, so do you work independently or do you guys work together? So how does that work?
So I sell insurance that's my job. I'm a financial planner. I sell insurance. So Raymond James has me as their insurance specialist. And so I work with this office. I work with all the Raymond James offices. I can work with all the Raymond James offices in British Columbia, Alberta, and Ontario, because I'm licensed for insurance in those ones. I can do financial planning across the country because that's not province specific. And then I also work with some people who are not Raymond James advisors or accountants and law firms. Also, I work with them as well. So there are investment clients of this team, and then as needed, depending on the advice they're looking for, then they would pull me in, or Erin is licensed as well. So depending on the type of conversation, either one of us would be able to help.
We're secure enough here to recognize when a situation is more complex than we typically, knowing that Jacqueline is dealing with it every day. In much the same way she could put together an investment portfolio to a certain degree, but would probably want a check and balance with somebody who's working in the capital markets on a daily basis. So Jacqueline's somebody, we've identified that we've got several people who are our clients, and they're just because people are their wealth is becoming more complex, their families are becoming more complex, so the insurance solutions are becoming very complicated. So we like a check and balance. Jacqueline is somebody who we go to. So that's also, to me, some authority. So if you have somebody of our credibility who believes that she has credibility, and then she says that this estate planner has that credibility, you start hanging around. Like the best thing, I had a great doctor once.
Where?
So great. So retired. No. So great. every referral she made was to somebody at her caliber. And that's when I started to see that like hits like. So Jacqueline in our world is known as somebody of great knowledge and integrity. And then you add the fact that she's working every day in it. She's simply faster than us, and we would use her as a check and balance, except for maybe a term insurance or something like that. We would just do a double check. So that's how we work together. Well, I really appreciate, there's no other further questions? Something that's just deeply living in you that
Oh, there.
there we go. The deep living question. Okay.
Okay.
Well, I've had critical life insurance
Oh.
on my brain for like probably 6 months.
Okay.
And it keeps coming up, so I know
Okay.
it's my intuition.
Okay.
So I'm thinking that everybody should have critical life insurance.
Yes.
It kind of makes sense. It's just that sometimes you don't know the route to take.
So for the most part, the reasons why you wouldn't need critical illness, you are independently wealthy, you are maybe if you are not able to retire at age 50, 51, 52, and you still have plans to work for a considerable amount of time, that would be another area, because heaven forbid something happened to you at 55 and now what? You were still intending to work. After age 55, the premiums get more expensive. Now, there are some tax strategies that we use critical illness policies when you have a corporation, so that's another type of planning there. But if you are on the younger side and still actively working, almost always, assuming you have a mortgage or relied on for income or anything like that, critical illness forms a part of it. Now, if there's a hierarchy of where to put your dollars for insurance, if there's $100 on the table and you've got young kids and a mortgage, life insurance might be the one that takes the premium, because the critical illness, hopefully you can recover from and then figure out a way. When you're gone, and there's no recovering from that. So it just depends on where is the hierarchy of risk and where do we then plan to put the dollars. But it's a conversation I have with probably every set of young child parents.
Yeah, I was looking at Blue Cross.
Okay.
And they were saying like these are the top 10 types of, like under critical illness you would be covered for these 10, and then another one had more than that. But I'm thinking, how would you choose what illness when you never know what it's going to be?
Yeah, so
It's very confusing.
it's funny. So there's those types where it's like a condensed list. The premiums are shorter or smaller because you have there's less things to claim on. There's some policies that cover your top three: stroke, heart attack, and cancer. So there's some policies that only cover those three things. In my opinion, the last thing I want is for someone to buy a critical illness policy and then come to me with the wrong critical illness. Much like there's accidental death and dismemberment life insurance, I never count on that as a group benefit plan. If someone has it, great, that's extra, but I never count on it on part of my calculations, because heaven forbid someone lose their spouse from a regular old illness and they come to me in tears and I go, they didn't die the right way, that's not going to pay out appropriately. We don't have enough coverage in place. So when it comes to those, I don't know Blue Cross products specifically, they're not ones that I contract with, but for the most part, the companies I deal with are anywhere from 30 up to 36 covered conditions. So I'll say like pretty much anything that you've ever seen a GoFundMe page creep up on is going to be covered under that scenario, which that's the other factor. There's your social media for trying to sell, and then if you've had the GoFundMe pages creep up, and maybe because I've now entered another age group, they just come up a lot more frequently. Like that is the blaring awareness of, like, if that's in your social circle, critical illness all over, unfortunately, because those are the policies that would pay out to avoid you coming to the internet crowdfunding for healthcare. So that is the direction to look at. The other factor, and again, I don't know the Blue Cross one, is that there's also these partially covered conditions. So if you have a policy for $100,000 of coverage and you have a life-threatening cancer or heart attack, they pay out the $100,000. But if you have early stage prostate cancer, early stage breast cancer, and a couple of other things, the success rate for early detection and surgery and treatment for you to survive that and go back to day-to-day living is so high that they won't pay out the full amount, but they will pay out usually up to 15%, up to certain limits. just as an extra. So it doesn't detract from the coverage you have. It's just an extra, I'll call it an inconvenience fee. You might have had to take some time off work, but you shouldn't have been necessarily significantly financially impacted. It's just an extra coverage component built into the plan as something happened. It wasn't life-threatening. You didn't have to like do huge treatment plans or something, but you were affected, and here's just a little extra thing for that.
Thank you.
And can you use it more than once? Let's say you're unlucky and
Sure.
your cancer metastasis.
So with critical illness plans, there's the base plan, and then there's something called riders. Insurance policies and disability policies have them too. You get a starting plan, and then you can add things onto it, kind of like an a la carte menu. So with critical illness, there's something called a second event rider, which means of the main three, if you claim on cancer, heart attack, or stroke, then they will pay out that first $100,000 or whatever it is you have. If you have the second event rider, it'll pay out the other. So if you claim on cancer, it'll pay out for a stroke or heart attack. If you claim on a heart attack or stroke, it'll pay out for cancer if you are unlucky with that. So it depends on the premiums and, again, best use of a dollar. So if the whole risk position and you've covered off everything, it depends on what the incremental increase in premium would be. Does that make sense for what you're trying to accomplish overall? It's something I don't use as often as some of the other considerations that might come into play there.
Is it worth it to me? My son is now a young adult, and I had insurance for him for the last 10 years for $1 million, and I think that maybe that's, I see how well he's doing, and I don't think, like, I'm paying, I think, almost $350 a month or so on insurance. I had cancer twice in the past, so maybe that's why my premiums were high, I don't know. But can I scale down? Can I?
Potentially.
Yeah.
So do you know what kind of?
Well, I don't know.
Okay.
Compared to what I have,
Sure.
I have the.
I can take a peek.
Yeah.
Here, you bring it out here.
Sure. Thanks. There are, maybe that's a side conversation. There are things to be done, and there's options. And the one thing I will preface is that if you have an insurance policy in place, if you look at it and go, maybe I don't need it, and you think, I'll just cancel it, maybe get a second opinion on what you can do with it. And some policies, if they're paid up or they have these versions, you can make some adjustments and make it paid up. If you don't need the insurance, you can donate them to charities. There's some tax benefits there. If you have a policy and you're like, well, I'm retired, I don't need it, mortgage is paid off, my kids are adults, you might want to ask them, do you want to take over the premiums? Is that,
I've thought of that.
that's another option?
There's another thing I think of is why don't I just put that money towards his whatever, TFSA or whatever. Like.
Yep. Another action would be like, does he need it? So for higher net worth individuals, the questions move from do you need insurance to what does your tax planning look like? So I have a lot of very wealthy individuals. I work with one lady, her net worth is over $50 million. She doesn't need any life insurance. She has $11 million of life insurance because there's a tax reason that we're doing that. So depending on your position, so if he might not need insurance, but might he want insurance? So it's the positioning of it and how it fits in with the overall financial framework.
Yeah. Because I mean, I've thought about it, and you know, I've done the maths, and until another 30 years,
Mm-hmm.
it's still. But then $1 million in 30 years is not really $1 million, right? And then
Yeah, there's some options there that may make sense for you, or it may, I mean, the end result still might be no, I don't need this anymore. But at least walk through the options to see what may or may not make sense for you or him.
It's also a little dangerous to be more useful to your children dead than alive.
I just told him about the policy maybe a month ago, and he was like, "What?"
That's what I'm saying. These are dangerous times. Somebody walk her out to her car. So thank you.
You're welcome.
Thank you, and thank all of you for coming.